What if everything you thought you knew about silver was wrong? You see silver as a steady, boring metal. It's that industrial commodity, tucked away in electronics. Or maybe it's just old coins in your drawer. But right now, something unbelievable is happening. It's not happening in London or New York. It's happening in Shanghai. The price of physical silver there has gone crazy. We're talking about a real tangible bar of the stuff. In Shanghai, it just hit a staggering $104 an ounce. Let that number sink in for a moment. The global spot price, the one you see on charts, that's barely above $30. So how is this even possible? How can the same metal have two completely different prices? This isn't a small gap or a tiny premium. This is a canyon. The spread has exploded. We're looking at a disconnect of historic proportions. And honestly, it makes no sense at first glance. It defies the basic logic of global markets. Because money should flow to where the price is highest, right? Arbitrage should snap this shut in seconds. But it hasn't. This spread is holding. In fact, it's widening. That tells us one thing. Something is broken, or something is being hidden. Which one is it? Let's peel this back slowly. First, forget the paper price for a second. That $30 figure, that's for futures contracts, for promises. The Shanghai price is for the real physical metal. You can touch it. And in Shanghai, they want to touch it very, very badly. Demand to actually take delivery must be enormous. But why there? Why now? It points to a massive local shortage. Think about that. A shortage so acute, it's creating its own financial reality. It's like a city paying $100 for a bottle of water, while the rest of the world pays $1. What would cause that kind of panic? Or is it even panic? Could it be something more deliberate? You have to ask the question. Who benefits from such a huge price gap? This isn't a minor market glitch. This is a screaming red siren, and it's flashing over the world's largest trading hub. So let's look at what $104 silver actually means. It revalues everything. Every single ounce in a vault, every bar, every coin. Suddenly, its potential value is tripled. But only if you can get it to Shanghai. And that's the multi-million-dollar problem, isn't it? You can't just ship a pallet of silver bars overnight. Logistics are a maze. Export controls can be a wall. So the physical metal is trapped. It's stuck where it sits. And the price in Shanghai is screaming into the void. Now think about the traders watching this. They see a guaranteed profit. Buy at $30, sell at $104. That's the dream. So why aren't they flooding the market? Why isn't the gap collapsing under their weight? The answer is in the fine print. The barriers are real and they're massive. It's not just about shipping costs. It's about permission. It's about quotas. It's about a wall of capital controls. China's market isn't freely open. The flow is restricted. So the price signal can't do its job. The market mechanism is broken. And when that happens, reality splits in two. You get two parallel worlds for one asset. Which one is the real price? Is it the paper world's $30, or is it the physical world's $104 where someone actually pays? Honestly, the physical price always wins in the end, because you can't build a solar panel with a futures contract. You can't make jewelry with a promise. Demand for the real thing is what matters. And in Shanghai, that demand is through the roof. But what's driving it? Is it industrial hoarding? Is it a strategic stockpile? Or is it something the public is doing? Could it be retail investors like you and me? Are people in China buying silver hand over fist? If they are, they're seeing a very different story. Their reality is $104 silver. They're paying that price right now, while the rest of the world sleeps on a $30 price tag. That creates a bizarre psychological divide. It makes you wonder which side is asleep, and which side is awake to a new reality. This isn't just a number on a screen anymore. It's a signal of pure, unadulterated stress in the system. So let's trace this stress back to its source. Start with the simplest explanation. Industrial demand. China is the world's workshop. They use silver in everything. Solar panels, electronics, electric vehicles. Consumption has been rising for years, but has it spiked on this dramatically? Enough to cause a 300% premium? Probably not on its own. Industrial demand is steady, predictable. This price move is neither. It's violent, it's emotional. So we look to the next layer, investment demand. When people lose faith in their currency, they seek hard assets. They buy what they can hold. Could a loss of confidence in the yuan be driving this? It's a compelling thought. But if that were true, you'd see gold soaring there too. And while gold is high, its premium isn't like this. Silver's move is in a league of its own. That tells us this isn't a broad currency play. This is specific to silver. Something unique is happening with this metal in China. Now, here's where it gets interesting. What if it's not about demand at all? What if it's about supply? What if the silver simply isn't arriving? Think about global supply chains. Mines in Peru, refineries in Europe. All of it has to be shipped, cleared, transported. A single disruption anywhere can create a bottleneck. And we've seen ports clogged. We've seen shipping costs skyrocket. Could a physical shortage of metal in Shanghai be this severe? It's possible. But here's the key question. Why aren't global prices reacting? If Shanghai is desperate for silver, the whole world should know. The London price should be rising to meet it. But it's not. It's like Shanghai is shouting into a soundproof room. The outside world isn't hearing the cry. Or maybe it's choosing not to listen. This silence is the most puzzling part. You have to ask, what don't we see? What's happening behind the official numbers? Is there a hidden accumulation happening? A stockpile being built quietly, bar by bar? When someone builds a stockpile, they don't announce it. They just buy. And they keep buying until the price tells them to stop. But in this case, the price hasn't stopped them. It's gone to $104 and they're still buying. What does that tell you about their need? It tells you it's urgent. It's not a casual purchase. It's a necessity. So we're left with two shocking possibilities. Either the market is failing in a spectacular way, or someone knows something we don't, and they're acting on that knowledge right now. Let's examine the market failure theory first. Markets are designed to find equilibrium. A high price should attract more sellers. It should encourage more metal to come to market. But what if the metal isn't there to be sold? Global silver inventories have been falling for years. Maybe we finally hit a tipping point. The cupboard is bare. And Shanghai, with its massive appetite, found the empty shelf first. That would mean this isn't just a Chinese story. It's a global warning. If the price in Shanghai is the true price of scarcity, then $30 silver everywhere else is an illusion. It's a paper illusion, propped up by derivatives and promises. And illusions can shatter very quickly. Now, consider the other possibility. Insider knowledge. What could they know? Is there a coming technological shift that needs vast amounts of silver? A new government mandate? A behind-the-scenes move to back a currency with something tangible? We can only speculate. But the scale of the buying suggests a large, coordinated actor, not a crowd of retail investors. This has the fingerprints of a strategic move. So, where does this leave an ordinary person watching this? You see a $30 price tag on your screen, but you now know that in the world's biggest market, it's $104. Which price do you believe? Which price is real? Your answer depends on what you trust. Do you trust the paper market with its layers of financial engineering? Or do you trust the physical market where real metal exchanges hands for real money? It's a fundamental choice, and the gap between them is a measure of distrust. This spread is a fever chart. It's measuring the market's temperature, and right now, the patient is burning up. But here's what history tells us. Gaps like this don't last forever. They're unstable. They create immense pressure. And that pressure has to go somewhere. It will either push the global price up violently, or the Shanghai price will collapse down. There is no middle ground. So the real story isn't the $104 price. It's the impending collision. Two versions of reality are on a crash course. When they meet, there will be a shockwave. The only question is which direction it travels. Will it lift the entire world's price of silver, or will it crush the dream in Shanghai? We need to look at the forces that could decide this. First, consider the force of money. Massive profit attracts massive capital. If the gap stays, smarter players will find a way through the barriers. They always do. They'll create new routes, new financial instruments. They'll chip away at the wall until the metal can flow. That flow would be a torrent. It would likely pull the Shanghai price down. But what if the barriers are meant to be permanent? What if this isn't an accident, but a policy? That changes everything. Then the price isn't a mistake to be corrected. It's a new reality to be accepted. Now look at the global miners. They see $104 silver. That's a powerful incentive to produce more. But you can't just turn on a silver faucet. Mines take years to develop, so increased supply is a slow, slow fix. It can't solve a crisis happening today. Next, look at the existing holders. If you own physical silver in London or New York, what do? Do you sell it locally for $30? Or do you try to navigate it to Shanghai for triple the price? The temptation is obvious. Every bar that makes that journey tightens the physical market elsewhere. It siphons supply from the west to the east. That alone should lift global prices. But the paper market is suppressing that. How? Through the enormous volume of futures contracts. Paper silver dwarfs physical silver. So the price is set in a paper arena, not a physical one. That's the core of the disconnect. We have a physical emergency contained by a paper dam. And the water is rising behind it. Pressure is building. You can see it in the Shanghai price. It's the leak in the dam. A small, localized spray at first, but leaks can become ruptures. So we watch that $104 figure. It's more than a price. It's a pressure gauge. If it goes higher, the structural integrity is failing. If it starts to fall, maybe the dam is holding. But remember, the dam is made of promises, not metal. And in a crisis, people want the metal. They don't want the promise. This is the ancient lesson playing out again. When trust fades, tangible assets speak loudest. Silver is speaking in Shanghai. It's shouting, in fact. The rest of the world is having a casual conversation. This mismatch can't continue. Something has to give. We need to understand what could trigger the break. The trigger could be something simple. A single large default on a futures contract, where someone promises to deliver metal they don't have. In a tight physical market, that's a real danger. It would send a shock through the paper system. It would force everyone to ask, where is the real silver? And the answer might be, it's already in Shanghai. That realization would be explosive. Or the trigger could be political. A change in trade policy. A sudden lift of an import restriction. That would open the floodgates instantly. The price gap would vanish in hours. But the surge of buying from China would hit global markets like a tsunami. Prices everywhere would spike. They'd have to. There's another possibility, a quieter one. A major financial institution could make a strategic decision. They could decide the paper game is too risky. They could start quietly swapping their paper claims for physical bars, and then they'd ship those bars east. If several players did this at once, the paper dam would crumble from within. No announcement, no headlines, just a silent run on physical metal. You wouldn't see it until it was too late. The warehouse inventories would just start falling. And then the panic would begin. So we're in a waiting game, a game of stability versus a single crack. Honestly, how stable do you feel the system is right now? Look at the debt levels, the inflation, the geopolitical tensions. Is this an environment for calm, rational pricing? Or is it an environment for hidden moves and desperate bids? Shanghai's silver price suggests the latter. It's a bid born of necessity, not speculation. That's what makes it so credible. And so dangerous for the status quo, because it challenges a fundamental rule, the rule that says there's one global price. Shanghai is breaking that rule. And by breaking it, they're revealing a truth. The global market isn't as connected as we thought. Or maybe it's connected only when it's convenient for certain powers. When it's not convenient, walls go up and prices diverge. This is financial fragmentation in real time. You're watching a single asset split into two worlds. One world of abundance at $30, one world of scarcity at $104. Most people live in the world of abundance. But if the world of scarcity is the real one, then a reckoning is coming. It's not a matter of if, it's a matter of when. The countdown might be measured by that spread. Watch it widen, and you know pressure is building. Watch it narrow, and you know the tension is easing. Right now, it's screaming wider. So what does an ordinary person do with this information? You can't easily buy silver in Shanghai, but the implications are global. First, you recognize the signal for what it is. It's a massive red flag for the entire precious metals market. It tells you the physical layer and the paper layer are separating. And in any divorce, assets get divided. Which side do you want to be on? The paper side offers convenience and low cost. You can buy and sell with a click, but you own a promise, not a thing. The physical side offers scarcity and tangible security, but it's cumbersome to store and move. Shanghai's price is a vote for the physical side, a very expensive, desperate vote. Now, think about your own situation. Do you have any exposure to silver at all? Most portfolios don't. It's the forgotten metal. But after seeing this, can you afford to ignore it? The issue isn't just about making a profit. It's about understanding systemic risk. This price gap is a symptom of a deeper illness. It's a sign that trust in the paper pricing mechanism is fraying. Maybe not in New York yet, but somewhere important. And these things have a way of spreading. Financial contagion is a real phenomenon. A crisis in one corner can infect the whole system, so you start asking different questions. You don't ask, is silver a good investment? You ask, what does this disconnect say about market stability? You ask, what else is priced incorrectly? That's the real chilling effect of the Shanghai price. It makes you doubt other prices. It breeds suspicion, and suspicion can trigger a rush for the exits, or a rush for the door of the vault. Historically, when localized premiums explode, they are eventually extinguished, but they are extinguished in one of two ways. Either the local shortage is relieved, or the global price rallies to meet the local price. Given the global supply constraints, which outcome seems more likely? It's hard to see a flood of new metal, so the path of least resistance is up. That's the logical conclusion. But markets aren't always logical in the short term. They are emotional and manipulated. So we have a battle. Logic and physical scarcity on one side, paper leverage and short-term interests on the other. Shanghai is the battlefield. And the $104 price is the territory gained by the physical side. The question is, can they hold it? And if they can, for how long? Every day it holds, it legitimizes the new price. It rewrites the textbook. It teaches a new generation of traders that $30 silver is a myth. That's a powerful psychological shift. And psychology moves markets more than any chart. So watch the traders. Watch the whispers in financial circles. Are they starting to believe the Shanghai price? If that belief spreads, the dam won't just crack. It will dissolve. Let's talk about belief for a second, because that's the final piece of this puzzle. A market price is just a shared belief until it's tested. Shanghai is testing that belief right now. They are saying, we believe physical silver is worth $104 an ounce, and they're backing that belief with cash. Real money for real metal. That's the strongest statement you can make. Now, what happens if London and New York start to believe it too? Even a little? You'd see a subtle shift. The paper price would start to creep up. Not to $104, but maybe to $35, then $40. The gap would narrow, not because Shanghai falls, but because the world rises. That's the bullish case for silver everywhere. And it's not fantasy. It's how supply shocks work. The shock happens in one place first. Then the price discovery ripples out. The ripple just hasn't reached the open ocean yet. But the stone has been dropped. The water is moving. You can see it if you look closely. Check the premiums for physical silver in your own country. Are they rising? Are coins and bars getting harder to find? That's the ripple effect. It starts at the edges in the physical dealer networks. The official spot price is the last to know. It's always the last to know. So the smart money isn't watching the spot price. It's watching the physical premiums. And it's watching Shanghai. They are the leading indicator, the canary in the coal mine. And right now, the canary is singing a very expensive song, so we have to consider the end game. How does this actually resolve? One scenario is a managed retreat. Authorities step in, release strategic stockpiles, or force sales to cap the Shanghai price. They guide it down slowly to avoid panic. That's the controlled outcome. And the other scenario is a runaway train. Demand overwhelms all attempts to control it. The price gaps up again to $120, $150. The global market can no longer ignore it. The paper dam breaks. And we get a repricing event, a single violent upward move that rewrites all the charts. Which scenario is more likely? Look at the incentives. Who benefits from control? Who benefits from chaos? The answers to those questions will tell you where this is headed. But here's what you need to remember. We are far beyond ordinary market dynamics. This is an extraordinary situation. It reveals a fragility we didn't know was there. And once you see that fragility, you can't unsee it. The market for a basic commodity is broken in a major financial capital. That should concern everyone, not just silver investors. It's a data point in a larger story of strain. So take a step back. Look at the bigger picture. What other assets might have a Shanghai moment? What other quiet disconnects are waiting to be discovered? This might be the first crack, not the last. That thought is the most unsettling one. If it can happen to silver, why not to copper, or nickel, or zinc? These are all industrial metals with tight supplies. They all flow through the same strained global systems. Shanghai might just be the first domino, the weakest link in the chain, and it has snapped. Now let's get practical again. What does the average person actually see from this? Probably nothing on the news. The financial channels aren't leading with this story. It's too niche, too complex. It's buried in specialist reports and trader chats. But the silence doesn't make it less important. It makes it more important. The biggest moves often start in the shadows. They build pressure where no one is looking. Then they break into the light with explosive force. So your job isn't to predict the exact day it breaks. Your job is to acknowledge the pressure exists, to understand that the landscape has changed. The $30 silver price now has an asterisk next to it. A big, glaring asterisk that says, except in Shanghai, where it's $104. That asterisk changes everything. It introduces doubt into a system that demands certainty. It's a splinter in the mind of the market, and splinters have a way of festering. Now, consider the reaction from the West. Official sources will likely call it an anomaly, a temporary distortion caused by local logistics. They'll say the fundamentals are still sound. They'll point to the steady $30 price as proof. But is that proof, or is it evidence of the disconnect? You have to decide who you trust. Do you trust the explanation, or do you trust the price action? Price action is money voting. And a lot of money in Shanghai is voting for $104 silver. That's a fact. You can't explain away a fact. You can only try to understand it. So we circle back to the core mystery. Why is the demand so inelastic? Why don't they stop buying when the price triples? The only answer is that they have no choice. Their need is absolute. It's not a discretionary purchase. It's mandatory. Think about what that implies for their planning. They see a future where silver is critical, and they see a present where they don't have enough. That's a dangerous gap to fill. They're filling it at any cost. This isn't investing. This is securing a strategic resource. When nations do that, price becomes a secondary concern. Availability is everything. That shifts the entire narrative. This isn't a speculative bubble about to pop. It's a resource grab playing out in real time. And resource grabs are not quiet affairs. They are loud, expensive, and they reshape markets for decades. We may be witnessing the opening act, the first public bid in a much larger game. A game where the pieces are ounces of silver, the board is the global financial system. That might sound dramatic, but look at the price. $104. Sometimes the most dramatic statements are just numbers. So where does this leave us today, right now? With a number that doesn't fit, a number that breaks the model, and broken models are where opportunities and risks are born. For the cautious, this is a warning sign to watch, a signal to reduce exposure to fragile paper-driven assets. For the strategic, it's a clue that physical assets in short supply have a hidden leverage, a leverage that appears when systems stress. But for everyone, it's a lesson in how modern finance really works. We have two parallel systems, one for paper, one for physical. They usually move in sync, so we forget they're separate. Shanghai is reminding us. It's holding up a mirror to the global market, and the reflection is distorted, alarming. Now you might be thinking, this is too big, it's out of my hands. And you're right, you can't fix the arbitrage or move metal from Zurich to Shanghai, but you can control your own understanding. You can decide to pay attention to the physical world, not just the digital ticker. That's the real takeaway here. When prices diverge this wildly, truth is found in the tangible, in the thing you can hold. That's an ancient principle. It's just been forgotten in a world of digital finance. Shanghai is the memory jolting us awake. So what's next? We watch. We watch the spread. Does it hold? Does it widen further toward $150? Or does it finally, slowly start to contract? Each movement tells a story. Widening means desperation is growing. Contraction means either relief is arriving or the world is catching up. We also watch for policy changes, a sudden announcement from a regulatory body, a change in import tariffs. Any political move could be the trigger. And we watch the other metals. Do their premiums in Shanghai start to jump too? If they do, the story becomes much, much bigger. It becomes a story about a broad commodity run. For now, it's isolated to silver. That isolation is itself a curious fact. It focuses the mystery like a laser. Why silver? Why only silver? The answer to that question might be the most important piece of all, because it could reveal the specific crisis they're preparing for. Is it an energy transition crisis, needing solar panels? Is it a monetary crisis, needing a historic metal? Or is it a supply chain crisis we simply can't see yet? We don't know. But they do. Their actions, their $104 bids, are the message. We just have to decipher it. And the first step in deciphering it is to stop seeing $30 as the real price. The real price is the one someone is willing to pay to secure the last bar. In Shanghai, that price is $104. That's the data point that matters. Everything else is commentary. Let's talk about that last bar mentality. It's a powerful force. It's not about value anymore, it's about survival. When you need the last bar, you don't haggle, you pay. This is the psychology at the extreme end of a shortage. And it seems Shanghai is there. So the real question becomes, how close is the rest of the world to that edge? The warehouses in London and New York claim to have inventory. But is it all available? Is it all unencumbered, ready to sell? Or is it tied up in complex lease agreements and ETFs? The truth is, much of it is spoken for. The visible stock is a poor measure of available stock. Shanghai may have simply run out of available stock first. Their crisis is our preview. Now consider the human element. Traders in Shanghai are just doing their jobs. They have orders to fill. Clients demanding metal. They go to the market, and the price is what it is. They don't care about London's paper price. They need the physical metal tomorrow. So they pay the asking price. This creates a feedback loop. Every high-price purchase sets a new benchmark for the next trade. The price ratchets higher, and with each tick, the urgency grows. This is how financial fear turns into tangible reality. It turns a number into a physical bar leaving a vault. It's a chain reaction we can't see, but we see its result. The $104 price tag is the result. So we have to accept that this is a real market. It's not an error or a glitch. It's a genuine price discovery event under duress. It's telling us the cost of immediate guaranteed possession. That cost is astronomically higher than the cost of a paper promise. That's the premium for certainty. And right now, certainty is in very short supply. Look around at the world. How many things can you be certain of? Not many. Shanghai is paying a 300% premium for one slice of certainty. That tells you something about their risk assessment. They see a risk so large, it justifies that cost. We should probably try to understand that risk, even if we can't see it yet. Because risks have a way of becoming visible when it's too late. So we piece together clues, we look at manufacturing data, strategic stockpile reports, trade flows. We look for the silent vacuum cleaner sucking up global silver. It's out there. Its work is reflected in the price. The $104 is its signature. Our job is to trace the signature back to its source. But time might be short. These situations can stabilize or they can snap. The tension is at its peak. What happens next will be studied for years. Will this be a footnote in financial history? Or will it be the chapter titled The Great Disconnect? We are all watching it write itself in real time. And we are not just spectators. Whether we own silver or not, we are affected by the stability of this system. A system now showing a deep structural crack. That crack has a sound. It's the silent sound of money moving in the dark. But for us, the public, the first sound we'll hear is likely a headline. Silver market in turmoil, or arbitrage crisis deepens. By then, the move will be halfway done. The smart money operates in the quiet before the headline. That's the phase we might be in right now. The phase of rumbling whispers, not public alarms. So let's talk about the smart money. What are they doing? Some are undoubtedly trying to bridge the gap. Engineering physical flows. Others might be buying cheap paper silver, betting the gap closes by global prices rising. It's a risky bet. But the biggest players might be doing something simpler. They might just be buying physical metal wherever they can, outside of Shanghai. They're buying the $30 silver, hoping it becomes the $104 silver by connection. This is the stealth play. It doesn't show up in a soaring spot price. It shows up in shrinking warehouse stocks and rising delivery delays. Those are the metrics to watch now, not the ticker, the logistics, the movement of real stuff, because that's where the next signal will come from. If London vaults start seeing unusually large withdrawals, the game is on. The siphoning has begun. The paper dam will feel the strain immediately. Now, shift your perspective for a moment. Imagine you're a central planner looking at this data. You see a critical industrial metal pricing itself into a crisis in your major financial city. Do you intervene? And if so, how? You could release metal from a state reserve to calm the market, but that depletes your strategic stash. You could impose price controls, but that just creates a black market. There are no good options, only less bad ones. This is the policy trap that Shanghai's price has created. It forces action from authorities who preferred no action. Enforced actions often have unintended consequences. They could accidentally validate the fear. They could signal that, yes, the shortage is real enough for government intervention. That might make people even more eager to get metal. It could backfire spectacularly. So authorities are likely paralyzed, calculating. Their hesitation is our window. It's the window where the market tells its raw, unfiltered truth. And the truth is $104. That truth is already changing behavior globally in small ways. A fabricator in Germany might think twice about selling his silver scrap now. He'll hear about the Shanghai price and hold out for more. A miner in Mexico might slow a sale, anticipating higher prices ahead. These micro decisions collectively tighten the noose. They reduce the available supply in the global pool, ounce by ounce. This is how a localized shock becomes a global one, not by a sudden event, but by 1,000 changed minds. The Shanghai price is changing minds. It's introducing a new anchor in people's thinking. The old anchor was $30. The new anchor is triple that. Once that new number is in people's heads, the old one loses its power. This is a psychological repricing, and it's already complete in one major market. The contagion of that idea is what we're waiting for. Will it spread? History says yes. High prices in one major region almost always pull up prices elsewhere. The mechanism might be slow, but the direction is clear. The only thing that can stop it is a massive, unexpected supply surge. And where would that come from? There are no new giant silver mines coming online. The earth isn't yielding more. So the path of least resistance, over time, is higher. Shanghai is just further along that path. They're in the future of silver pricing. The rest of the world is in the past. The collision happens when the past catches up. Catching up can be a violent process. It's not a gentle trend line on a chart. It's a series of jagged overnight leaps. Liquidity vanishes, and prices gap. That's what happens when a slow trickle of doubt becomes a flood. We haven't seen the flood yet. We're still in the trickle phase, but the water is rising. You can measure it in the tightening spreads between wholesale and retail silver in your own country. You can see it in the delivery delays from major online dealers. These are the capillary actions of the main event in Shanghai. The system is connected, after all, just not in the way the spot price shows. It's connected in the physical pipeline, and that pipeline is under strain. Now let's be clear about one thing. This isn't a prediction of immediate doom. Markets can remain disconnected for longer than anyone thinks possible. The $104 price could sit there for months, a strange outlier. The world could get used to it. That's the bizarre part. We get used to financial anomalies. They become the new normal until they aren't. The key is to not get used to it. To remember that it is an anomaly, a screaming anomaly that indicates a broken function, and broken things eventually get fixed or they break completely. So we watch for the fix or the final break. What would a fix look like? A coordinated release of metal by several governments or exchanges. A major new silver discovery announced. A sudden deep recession killing industrial demand. These are possible, but not probable today. What would a final break look like? The London Metal Exchange or COMEX having delivery issues. A major ETF unable to source metal to back its shares. A public admission of a physical shortage by a mainstream institution. These events would be landmarks. They would be points of no return. We're not there. But Shanghai tells us we're closer than we were yesterday. That's the progression. not from calm to crisis in a day, but from calm to strain, strain to stress, stress to fracture. Shanghai is the stress phase. Global markets are in the strain phase. The fracture phase is still ahead. The bridge between them is made of confidence, confidence that paper will always equal metal. Shanghai is shaking that confidence. How much shaking can it take before it snaps? No one knows the exact threshold. But we know the shaking is getting harder. Each day at $104 is another tremor. So the task is simple but not easy. Monitor the tremors. Watch for the first true crack in the Western system. It will be small at first. A missed delivery here, a surprising premium there. It will be dismissed as a one-off. But after Shanghai, you'll know better. You'll see it for what it is. A symptom of the same disease. A disease of scarcity in a world of paper abundance. That's the core contradiction we're facing. And contradictions resolve. They always do. The resolution is what changes everything. Let's talk about what that change could look like in practical terms. If the physical shortage becomes undeniable, the pricing model inverts. The paper market would have to follow the physical market, not lead it. The tail would wag the dog. This would upend decades of financial convention. Hedging strategies would fail. Mining company finances would be thrown into chaos. ETFs would face existential questions. It would be a quiet revolution in the commodities world. But revolutions are never quiet for long. They spill over into currency markets as the cost of goods shifts, into bond markets as inflation expectations jump, into equity markets as company profit margins get crushed by input costs. This is how a single commodity dislocation can ripple outward. Silver is a small market, but it's a canary for supply chains, for monetary trust, for market structure. Its $104 price in Shanghai is the canary gasping. So the prudent move isn't necessarily to buy silver. The prudent move is to check the air in all your coal mines. Reevaluate your assumptions about how smoothly things work. Assume less, verify more. That's the mindset this event fosters. Now, take a step even further back. Why does any of this matter to someone just living their life? It matters because prices are signals. They tell us what's scarce, what's needed. When a signal gets this distorted, it means the information system is failing. And we all rely on that information system to make decisions, from what car to buy to what job to train for. A false price gives false information. It leads to bad decisions, wasted capital, misallocated resources. Shanghai's silver price is a giant flashing error message in the global pricing matrix. Ignoring error messages is how systems crash. You don't have to understand the code, you just have to heed the warning. So what's the warning here? The warning is that foundational markets are not as liquid or as deep as we thought. The physical layer is thin, dangerously thin. And when demand presses on that thin layer, strange things happen. Prices decouple. Reality splits. We get two truths for one thing, and in the long run, there can only be one truth. The market will find it. The process of finding it will be volatile. That's the ultimate takeaway. Prepare for volatility in things you thought were stable. Not just silver, but in all the basic building blocks of the economy. Because if it happened here, the conditions exist for it to happen elsewhere. The preconditions are global: strained supply chains, high debt, geopolitical friction. Shanghai's silver is the first spark in a tinder-dry forest. Whether it ignites a blaze or fizzles out depends on the wind. The wind is the flow of money and policy. Right now, the wind is blowing and the spark is glowing. We watch to see if it catches. We listen for the crackle. So far, the crackle is only in one city, but sound travels. Sound travels through data, and the data trail is getting harder to ignore. Specialist financial blogs are picking up the story. Commodity analysts are writing frantic private notes. The whispers are becoming conversations. Soon, there'll be debates on mainstream financial television. That's the contagion vector, not just metal moving, but information moving. The idea of $104 silver is a meme now, a financial meme with real-world consequences. And memes spread faster than ships. Once the idea is loose, it changes behavior instantly. A European investor hears it and decides to swap a bond for a silver bar. That decision, multiplied by thousands, is a market-moving event. It happens silently, electronically, no fanfare. But the metal moves from an exchange vault to a private one. Liquidity drains. This is how a narrative becomes a physical fact. Shanghai started the narrative. The world is now reading it. The next step is believing it. And belief, as we know, is a powerful force. Now, let's ground this again. What's the worst-case scenario from a mainstream perspective? A panic bid into physical silver ETFs, draining their vaults. A scramble by industrial users to lock in long-term supply, worsening the shortage. A loss of credibility for the paper futures exchanges. These are serious outcomes. They would attract regulatory firestorms. So the authorities are on alert, you can be sure. Their goal will be to manage the narrative, to calm the meme. They'll issue statements about ample supply. They'll point to rising warehouse stocks in some locations. They might even engineer a price drop in the paper market to discredit the physical price. This is the battle. The battle between a physical fact and a narrative of control. The $104 price is the fact. The everything is fine story is the control. One of them will break. You've seen this pattern before. In housing in 2007, the fact was defaulting mortgages. The control was subprime is contained. We know how that ended. The facts won. They always do, eventually. But the timing is the torture. It can take so long that everyone gets bored and looks away. Then it breaks. So stay focused on the fact. The fact is not a theory. It's a transaction price in the world's second largest economy. People are paying it. Right now. That is the North Star in this story. Everything else is noise. The noise will say it's temporary, logistical, anomalous. The fact says it's real, transactional, and persistent. Your job is to listen to the fact. Watch for its echoes. If the fact starts to spread, if other physical markets show similar premiums, then the control narrative is losing. If the fact remains isolated, the controllers might win this round. But remember, a contained fact is still a fact. It proves the breakdown is possible. And possible becomes probable, then inevitable under the right stress. We just have to see if the stress increases. Look at the broader economic indicators. Do they suggest more stress or less? Your answer will tell you where this silver story is headed next. It's never just about the metal. It's about the pressure in the entire system. Silver is just the gauge. And right now, the needle is deep in the red. So we arrive at the end of our look at this unbelievable situation. But the situation itself is far from over. It's ongoing, ticking, with each trade in Shanghai. The final chapter hasn't been written. We're still in the middle of it. The takeaway isn't a simple call to action. It's a call to attention. Pay attention to the cracks. This is a masterclass in market fracture happening in real time. You've seen the numbers, the logic, the possibilities. Now you carry that knowledge with you. When you hear about market volatility in the future, you'll think of this. You'll understand that volatility isn't an abstract force. It's the sound of reality reasserting itself over fiction. Shanghai's silver price is a loud burst of reality. It's inconvenient, it's messy, and it doesn't fit the model. But it's true. And in finance, truth has a way of collecting its due. It might take days, weeks, or months, but the bill always comes due. For now, keep one eye on that spread. Let it be a reminder that the maps we use to navigate the financial world are sometimes wrong. A $104 price in a $30 world is a landmark off the map. It tells you the territory is different than you thought. Your job is to survey the territory again, with new eyes. Don't assume stability, observe it, verify it. And when you see another crack in another market, you'll recognize the pattern. You'll have seen it here first. That's the real value of understanding this event. It's not about silver. It's about recognizing the signal of systemic strain. So as we end, the story doesn't end. It continues on trading floors, in vaults, and in the decisions of everyone who sees that number. The number is $104. Remember it. Watch it. Let it remind you that in global finance, sometimes the most important stories are the quietest and the strangest, until they aren't. And with that, we'll leave it there. Stay curious, stay observant. The market is speaking. We just have to learn how to listen.